Hi guys, welcome back to this week Technical Insights. Singapore shares end the week lower, even though major markets in our region closed higher on Friday, 27th of October. The STI index fell 0.31% or 9 points to close at 3,061 points. On the broader Singapore market, winners beat losers 344 to 257 after about 1.24 billion shares worth 883 million were traded. Within the STI, the CapitaLand Integrated Commercial Trust was the biggest winner on Friday. The Real Estate Investment Trust unit rose 1.8% or 3 cents to $1.74. At the bottom of the STI table was Singapore Airlines, which shed about 2.4% or 15 cents to close at $6.06. On Thursday, the Ministry of Manpower reported that the retrenchments in Singapore climbed in the third quarter, even as the labour market expanded for 8 consecutive quarters. The ministry also warned of a slow uptrend in unemployment rates, even if they remain low due to continued labour market tightness. In the third quarter, there were about 4,100 layoffs, up from the 3,200 in the previous quarter. This is the highest number of quarterly retrenchments since fourth quarter of 2022 during the COVID-19 period, and brings the year-to-date retrenchment figure to 11,120. That's almost double the 6,440 recorded in the whole of last year. Major markets in the Asia region were in the green. Japan Nikkei 225 index gained 1.27%, while the Hong Kong Hang Seng Index rose about 2.08%, and Shanghai Composite Index also climbed 0.99%. For the week, on the global indices, renewed selling on fears of a recession dragged the 3 major US indices lower last week. The Dow Jones Index lost 2.14% to end at 32,417 points, pressured by declines in JP Morgan after the CEO Jamie Dimon said he planned to sell 1 million shares next year. The S&P 500 dropped about 2.53% for the week and entered the correction territory, finishing at 4,117 points. This is 10.3% lower from the year's peak on 31st July. The Nasdaq Composite Index, meanwhile, fell 2.62% in that time to close at 12,643 points, dragged down by the steep declines in the Facebook and Google parents, Meta Platform, and Alphabet. Traders were weighed down by the new inflation data after the core PCE reading for September was released ahead of the FOMC meeting next week. PCE is the Federal Reserve preferred inflation gauge, and core PCE increased 0.3% in the last month and 3.7% year-on-year, matching estimates from economists. However, consumer spending increased by 0.7%. That surpassed the estimate of 0.5%. Markets in general still expect the US economy to slow down, and the only question here is how much is it going to slow down and how fast is it going to be? Our local bank's performance for the week were pretty much mixed for the week. DBS was up 0.15% for the week to $33.13. UOB led the declines among the 3 banks for the week to decline 2.63% to close at $27.03. OCBC slipped 0.23% for the week to close at $12.76. SGX ended the week down 1.56% to close at $9.44. The biggest winner on the STI index last week was Genting Singapore, up 4.19% to close at 87 cents. Hong Kong Land, meanwhile, was the biggest loser on the STI index, losing about 6.51% to close at $3.16 on Friday. So for this week's technical analysis, let's look at both Genting Singapore as well as Hong Kong Land. First, let's look at Genting Singapore, whose shares surged about 4.19% last week to close at 87 cents. The company shares recently clocked a near-to-date low on 6th of October at 81.5 cents. This was also the low that we observed on last year, 28th of November. Since the year-to-date high on 4th of April at $1.15, price has been on a downtrend for the past 6 months. However, since hitting the year-to-date low on 6th of October, the price has retested this level again last Tuesday and managed to stay above that level, forming a double bottom formation around the 82 cents level. This will be a clear support level for Genting Singapore, with the 20 days moving average in white and the 50 days moving average in yellow providing further support at the 84 cents and the 86 cents level respectively. On the resistance end, the stock breached the upper bound of that Bollinger Band at 86.5 cents. The next resistance level may be the double top formation connecting the high of 14 July over here as well as 11 August at a price level of about 95 cents. Above this, the next resistance level may be the 200 days moving average where the red line looms, which is now the long-term resistance for Genting Singapore at 96 cents. Looking at the MACD indicator, the MACD histograms appear to be gaining momentum, at least for the past 3 trading sessions. The MACD line seems to be diverging away from the signal line and is looking to breach the MACD zero baseline pretty soon, a sign that the uptrend we saw last week is likely to continue. The latest reading on the RSI indicator last Friday was at 58, and it was up from the 6th of October year-to-date low reading of 28, which triggered the oversold signal on the RSI that day. The crossing of the RSI above the 50-point neutral mark last week is also another sign that the rebound we saw last week was gaining traction and momentum. With both the technical indicators showing positive signs, traders may consider the 20 days moving average at 84 cents as the entry, or even the year-to-date low at 81.5 cents to target the 200 days moving average at 96 cents. Next, let's have a look at Hong Kong Land, whose share sank about 6.5% last week to end at $3.16. The year-to-date high was achieved on 30th of January at $4.75, and the year-to-date low was clocked last week on 25th of October at $3.07. The primary trend that we observed since the year-to-date high in January this year is a predominant downtrend. The pullback that we saw recently since the high on 7th of September over here at $3.71 means that the share price has since retracted more than 17% in a very short period of time. The 20 days moving average, which is the white line that you see here, crossed below the 50 days moving average, which is the yellow line, somewhere on the 3rd of October, a sign that the downtrend was likely to accelerate, and the divergence of the 20 days moving average line from the 50 days moving average confirmed that signal. The lower bound of the Bollinger Band is now reading at $3.10, and if this does not hold, the next low we could see could be the low in 2009 at $1.76, which is a very steep drop. The resistance level can be seen at the 20 days moving average, which is the white line over here, at $3.38, and the 50 days moving average, the yellow line, at $3.46. Looking at the MACD indicator, the gap between the MACD line and the signal line is still pretty wide, indicating that the downside or negative momentum is still pretty strong. The latest reading on the RSI last Friday was 40, up from last Wednesday low reading of 27. The lowest RSI reading observed this year was 23. So even though we may have crossed the 30-point oversold mark, it is difficult to foresee a sustained rebound for Hong Kong Land till we see the RSI retest the 23-point RSI year-to-date low reading again. So for now, the preferred position will be to take a short position at the 20 days moving average at $3.38, or even the 50 days moving average at $3.46 to target the year-to-date low again at $3.07. And with that, we have come to the end of this week's video. If you find this useful, do consider giving us a like or a share and hit that subscribe button to stay up to date to our latest content. And I'll see you again next week in the next Technical Insights.